So welcome back to Ask the Hammer with Jeffrey Levine of Buckingham Wealth Partners, where we take your questions about everything and everything and everything having to do with money. Jeffrey, I've got a tough one for you if you're up for it.
Sure.
So the question reads, I'm about to retire from a county job where I have a pension and the option to take one of three options. One option will provide me with my full retirement allowance in monthly payments as long as I live. However, all allowance payments stop when I die and no benefits are paid to or provided to my survivors. Option B, a lifetime allowance to me that is about 1 to 5% less per month than the first option. The annuity portion of my allowance is reduced to allow a benefit for my beneficiary, and then upon my death, my surviving beneficiary of record will be paid the remaining balance of my accumulated total deductions from my annuity reserve account. And then the last option is a joint and survivor or joint and last survivor allowance, which provides me with a lifetime allowance of about 7 to 15% less than that which I would receive under the first option. And then upon my death, my designated beneficiary will be paid a monthly allowance for the remainder of his or her life. The survivor benefit will be equal to 2/3 of the allowance that was being paid to me at the time of my death. What are your thoughts about what I should consider when I make this decision?
So this is the classic pension dilemma. I have 75 choices, in this case only 3, so perhaps not as many as some other places, but this is a very classic pension dilemma for individuals, especially government workers, because governmental workers are so much more likely than private sector workers today to have the option of a pension to begin with. So the first thing we should do is say, like, congratulations, it's a wonderful thing to have a pension today, and these are good choices to have to make, right? It's how do I want to collect money in retirement is always a nicer choice than where am I going to get money. Now, that said, obviously, this is a critical decision, and so I would say the answer to this question is quite simple. I just need 2 pieces of information. I just need to know exactly when this person will die and when their beneficiary will die. And I can give the exact answer down to the day, of what they should be doing. Now, of course, no one has that foresight, right? So what comes into play here are things like goals and risk aversion. So first thing is, how important is it to you to provide income for another individual, presumably your spouse in this case? And if that is really important, or how important is it to them? What other assets or income sources do you and that person have together such that if you happen to pass away early, that I like to use the example of being hit by a bus as you leave my office when we have these discussions, right? Because no one wants to think it's a heart attack, but when we talk about, walking out of my office and getting hit by it, we know, not that that's a lighthearted thing to think about, but it's like we get it's a hypothetical, but that's the thing that you need to do in your mind is say, what's the worst case scenario here? And how would that impact the people I care about most? Would they be able to survive? Would they have enough? And if not, what would they do, right? Could they go back to work? Are they young enough to do that? Would they have to, go move in with other, would they have to dramatically decrease their standard of living? These are all critical questions. And then the other part is, looking at the pension as a whole, we all want the most amount of money, right? If the individual, let's say, lives a full life expectancy, well, maybe the better thing to do is to take those full checks, if you will, and to kind of save some each paycheck, such that if they happen to die early, there's a pile of money left for the surviving spouse. Or perhaps another way to go about this, something that is classically referred to as pension max, short for pension maximization, is simply that individual with the option to take the full check decides to do so, but takes a small portion of it and buys some sort of life insurance policy, again, such that if they pass away early on, there's enough money left for others there. So I think the first thing to consider here is, let's start with the goals, right? Let's figure out what are the things that are most important to you right now. Is providing that additional income or benefit for a spouse absolutely critical? If so, then we want to look at maybe those second 2 options, or perhaps that pension max situation. Are you comfortable taking a gamble on your own life to try and get the maximum here on your own check? If you live 20 years and your spouse lives 20 years, well, guess what? It was better to take the higher amount because your spouse didn't outlive you. So there are all these little wrinkles, but again, you start with the goal. it's nice to end up with the most money, and it's nice to make the perfect financial decision. But because we don't have the ability to do so, right? It's like when you're playing poker and you dealt a couple of aces, right? Before the hand starts. No matter what happens, you're putting your money in. Doesn't mean you're going to win your hand. Anything can happen when the deck, it gets shuffled and the cards come out. But you do what's right at the time based on the information that you have available at the time. And so I would just strongly encourage that individual, A, to consider the things that are most important to them first, and worry about making sure that those things have the highest probability of happening. And then B, after that, exploring all the various options, which not only include those that are offered by the plan, but also things, again, like a pension max situation. Obviously, a lot of this is going to depend on your health. This will depend upon your spouse's health, et cetera. But that individual would be in the best position of all of us to know those things.
Yeah. In my experience, I like to tell people that they should really think about the household and not just themselves when they're making this decision. And
Sure.
I'm often reminded of the fact that the percent of widows in this country that live below the poverty line is staggeringly high from my perspective. And I think some of it could be avoided by making the proper pension choices in cases like this.
Absolutely. And a lot of demographics come into play here, right? Like typically, especially the generation that's retiring now, women tend to be 1, 2, 3 years younger than their spouse. They tend to live 3 or 4 years longer. So now you're talking about on average, let's say a 6 to 7 year, if not more, a length of time where the average spouse might outlive, the average widow might outlive her husband if things just go, quote unquote, according to plan, if you will. And, that creates a lot of headaches. Now, remember, at a best case scenario, that spouse is still losing one Social Security check, right? So there's income loss no matter what. And oftentimes, the survivor is actually subject to higher tax rates than the individual, even if they have less income, thanks to what we like to refer to as the widow's penalty, essentially going from the nice, cushy joint brackets down to brackets that are essentially half the size for single filers.
Right. And the other factor to consider is your expenses aren't cut in half necessarily just because one of the couples dies, right? Your electricity bill
That's
isn't
right.
50% less, or your car insurance isn't 50% less.
Your taxes are not, you're more,
Right.
your property tax. Yeah, one of the biggest mistakes I think people make to that point is actually overestimating the reduction in expenses. By the time, most people get up to, let's say, their later 70s, or they've stopped doing the things even that cost them more or double, if you will. In other words, like they don't have 2 cars anymore a lot of the time. Even if they cut, it doesn't matter. They don't have 2 cars. They share one because they don't drive that many places anymore. Or, buying food for one person versus buying food for 2 people is not half the cost. You essentially are the same cost, maybe save 1 or 2 specialty items that other person used to enjoy, because you just can't buy small enough amounts to do those things. So these are all important concerns. And I completely agree with you that you have to look at these as a household decision, at least if you care about your family. I mean, that's, that's it's kind of harsh, but it's kind of true.
Yeah. Well, I think that merits a hammer, Jeffrey. I think we've helped them, that person, with their question.
Fantastic.
All right, you've got questions. We've got answers. Just ask the hammer. Jeffrey Levine from Buckingham Wealth Partners. Thanks, Jeffrey.
Thank you.